Hi, and welcome to JHU TAMID's presentation on Introduction to Fundamental Analysis. Today we're going to talk about fundamental analysis in three different parts: balance sheet analysis, the income statement analysis, and the cash flow analysis. Afterwards, we're going to do a workshop analyzing two competing companies and see which one we'd rather invest in. So let's start with what is fundamental analysis. Fundamental analysis is the foundation of solid investing. It helps you determine the underlying health of a company by examining the core business's numbers, its income statements, its earnings releases, its balance sheet, and other indicators of economic health. From these fundamentals, investors evaluate the stock, whether or not the stock is over or undervalued. Fundamental analysis is an extremely broad topic that can refer to any number of qualitative and quantitative measures. For all purposes, JHU TAMID will focus on three areas of fundamental analysis: the balance sheet analysis, the income statement analysis, and the cash flow analysis. We will talk about each of these areas more in depth, but feel free to go and explore some other ways and methods of fundamental analysis, because every company and site you go to should and will have a different set of criteria. So let's start with the balance sheet analysis. Every publicly listed company worldwide is required to report earnings and other financial information on a timely basis. This information is given to investors so they are better able to understand the financial well-being of a corporation. This information will be distributed according to one of two standards: GAAP or IFRS. Most U.S. companies will use GAAP, and most international companies will use IFRS. It's like the metric system and the customary system. Only the U.S. uses GAAP. And one day we might switch to IFRS, but don't count on it anytime soon. Either way, most Israeli companies are going to be under IFRS, and all of this information can be found annually using the company's Form 10K or quarterly using the company's Form 10Q. This is public information, and they're just fancy words for financial statements. Each financial statement is going to have four different parts: the balance sheet, the income statement, the statement of cash flows, and the statement of retained earnings. Now you should understand where we got our three methods of analysis. Starting with the balance sheet, there are three main types of information: assets, liabilities, and shareholders' equity. An asset is a resource a company owns that has value. Some examples would be machinery, office buildings, cash, inventory, factories, accounts receivable, tractors, trucks, anything you use that has value to create a profit. There are going to be two types of assets. One would be your current assets, and one would be your non-current assets. A current asset is cash or cash equivalents, or anything that is cash or will be cash within the span of 1 year. So what does that mean? So if I sold a piece of furniture and I said, all right, you can pay me in 1 month at 2% financing, what you hear the commercials on TV about all the time, that means they're paying me back in cash money in 1 month. That account receivable is going to be a current asset. Any inventories are going to be current assets, because those are things you're going to sell within the next year. Compare those to the non-current assets, which would be your machinery, buildings, factories, furniture like desks, computer systems. All those types of things are things I'm not thinking about selling within a year. Those are things that would not be considered a current liability, or would not be considered a current asset. Talking about current liabilities, liabilities are obligations the company has made to outside parties who have provided resources. Some examples would be accounts payable, or money people owe you, income taxes payable, customer deposits, interest payable, or long-term debt, short-term debt, anything that requires me to pay money to someone else in the future. Same with just the same as assets, they're going to be current liabilities and non-current liabilities. A current liability is something I'm going to have to pay in cash within the next year. A non-current liability is something I will not have to pay in cash within the next year. So that would be like a long-term 30-year mortgage, or a loan I'm paying back over 5 years, or money I don't have to pay back for 2 years. Anything that's over an extremely long period of time is going to be a non-current liability. An account payable, or something I have to pay back in 90 days or 60 days, that would be a current liability. And the third part of a balance sheet is the shareholders' equity. This is capital obtained from sources other than creditors, aka investors, so us. Money investors paid to the company to buy stock during the initial IPO. This is called contributed capital. This is all money that the public corporation got only during the initial IPO. When you buy and sell stocks, that money never actually goes to the company. So this brings us to our first method of analysis, the current ratio. The current ratio, you see an extremely simplified version of the balance sheet on the right-hand side of this screen. You have your current assets on the top and current liabilities. You have your total current assets. It's going to be on every balance sheet, whether it be GAAP or IFRS. They're going to have the total current assets and total current liabilities already summed up for you, so you don't have to do any math. But what they're going to give you is they're going to give you the current assets and current liabilities, and we're going to want to know what the current ratio is, aka how your current assets compare to your current liabilities. The current ratio is going to be equal to your current assets over your current liabilities. And as you can see for this example corporation we have on the left here, you have $25,000 worth of current assets, $14,000 worth of current liabilities. When you put those two over each other, you get your current ratio equal to 1.79. Now, what does 1.79 mean? That means I have 1.79 times as many assets as I do liabilities. Looking at it from a creditor standpoint, I'm going to want to see 2 as a standard benchmark for a healthy company. That means I have twice as many assets as liabilities. If the number is less than 1, that means I have more current liabilities than I do current assets. I'm not going to be very happy with that. As a creditor, I'm going to be very worried. As an investor, I don't really care about the benchmark of 2. I do care about the red flag of 1. What I really want is the largest number possible. The bigger, the better from an investor. That means I have way more, the more assets compared to the liabilities, the happier I am. So that's the current ratio. And the next thing we're going to look at is the retained earnings. This is the income that has been kept by a company, i.e. not paid out in dividends. Investors want to see a steady growth in retained earnings. So look at this company down here at the bottom. It's Teva Pharmaceuticals. It's an Israeli pharmaceutical company traded on the New York Stock Exchange. You have your 2015 numbers on the left and your 2014 numbers on the right. And I'm going to want to see my retained earnings and how fast those grow year to year. And I'll compare that to previous growth rates, or previous years, the 2013 to 2014 growth rate. I'll compare that to competitors' growth rates, and I'll compare that to the industry. I'll compare that to the industry average growth rate. So what we're going to see here is your 2015 number and your 2014 number. We're going to subtract the 2, your 14,657 minus your 14,436, and you get $221. It's not actually $221. All these numbers, it'll tell you at the top of the financial statements, are listed in terms of millions. So I'm going to add 6 zeros to the end of that. So it's $221 million growth in retained earnings. I'm going to find my percent change of that. So what I would do is I'd put my $221 over my original 14,436, and I get a 1.53% change. Now, how do I know if that 1.53% change is good? If in 2013 they grew at a 0.5% rate, this would be very good news. If I looked at a competitor like the largest pharmaceutical company in the US, Pfizer Pharmaceutical, and they grew at a rate of 3% last year, I would be worried. Why am I growing slower than Pfizer Pharmaceutical? If the industry, or for example, if the industry grew at a rate, shrunk, for example, say the pharmaceutical industry shrunk by 0.5% last year, but I grew at a percent of 1.53%, I would be very, very happy with that number, saying I'm outperforming the rest of it, outperforming the rest of the industry. But now you're getting a pattern. We're going to pull financial information from the financial reports and use it to analyze a company's current position. The income statement, our next method of analysis, is going to consist of 2 things, revenues and cost. Revenues are going to equal sales, or money I get from the sale of goods or sales of services. Revenue, we're going to want to focus on revenues from core products and services. This is called operating revenues, and growth in operating revenue is essential to a healthy business. sales should be increasing, and we should see growth trends for 3 to 5 years. Remember, we're long-term investors. We don't care about the next 2 months. We care about the next 5 years. Expenses are quite the opposite. They're costs incurred by the business to sell something. So this would be like that $18 it took Walmart to buy a DVD, and then they sell it for $22 to me. So that $18 is the cost incurred by Walmart to sell that DVD to me. Declining expenses indicate either increasing productivity or reduced costs in selling, or reduced research and development spending. Reduced research and development spending is not necessarily a good thing because it reduces your ability to make profits in the long run. Increased expenses is not necessarily a bad sign. You want to know what caused the increase in spending. Example, if the increase in spending was caused by an increase in research and development spending, it's a good indicator of future growth. It means the company is investing in its future earnings, which is something we always want to see. Now, this is a very simplified version of the income statement. You have your sales of products, sales of services added together equal to your total sales, marketing and promotion costs, your payroll costs, your other costs, all added together to equal your total expenses. You subtract the two and you get your net income. Now, if life was this simple, it would be great. But this is what an actual income statement looks like. It's much more complicated, and notice there's a lot of information. And what we need to know how to do is how to find the information we need and discard the rest. So the first two numbers we're going to look at are net profit margin and our earnings per share. The net profit margin shows how much of their sales turn into profit. Higher, the better. And your earnings per share is going to be your net income over your number of outstanding shares. The company on any financial statement is going to tell you how many outstanding shares they have, and they're either going to give you your earnings per share or you're going to be able to calculate it from the information they give you. Once again, the higher, the better. So net profit margin, if say Apple is making an iPhone for $50 and they're selling it for $500, that means the net profit margin is 90%. We're going to do the net income, which let's say is net income is that $450 and the net sales is that $500, and that's how we get the 90%. You're always going to express this in terms of percentage. Your earnings per share, it's going to be your net income over your number of outstanding shares. So if a company is making $100,000 a year and they have 100,000 shares, that means earnings per share is going to be $1. Now, $1, if it's only a $10 stock and you're making $1, that's a great number. That means they made a huge amount of money compared to the stock price. The stock price is going to go through the roof. It's a $700 stock and it makes $1 per share. It might not be as good of news. So we look down here. We're looking back at our income statement. We're going to look at how to find that net income number. That net income number is going to be buried in between a lot of other things. You're going to see you might get confused with the net income attributed to Tiva. We're going to focus simply on when it says net income and net revenues. Net revenues, aka, remember when we said revenues equals sales? Net revenues is another good word for net sales. So we have our two net income numbers right here, and we have our two net revenue numbers. And those are numbers we're going to want to look at to get the net profit margin. For the earnings per share, once again, we're going to look at the net income. And luckily for us, instead of giving us the number of shares, they gave us earnings per share attributed to Tiva. We're going to look at the basic number, and we can see in the 9 months ending September 30th, the earnings per share attributed to Tiva was $1.28. Last year's $2.78. We're going to want to ask ourselves, what caused this decline? Why are they making less money this year than they did last year? So the next two numbers we're going to look at is a price to earnings ratio and a price to earnings growth rate. The price to earnings ratio is going to show you how a company is viewed by the market. A high price per earnings means the market sees the company as a high growth company. This would be a price per earnings greater than 20. A low price per earnings ratio, it's not a bad sign, but it's going to be indicative of low growth. If it's less than 10, it's going to be a Johnson & Johnson or a P&G or a GE or a Boeing corporation, a corporation that's seen a lot of its growth already, and it's not growing at an extremely fast rate. A company like Google or Netflix, those would be something that you might see a high price per earnings ratio in, because they're growing very, very fast. Thus, the growth is already calculated into the cost of the stock. Price per earnings growth rate, this is going to tell you whether a company is over or undervalued. If a PEG is less than 1, it's a good sign the company is not overvalued. Not necessarily undervalued, but it's a sign that the market is not going crazy over its valuation. A very high number is a warning sign. It's something you're going to want to look deeper into. It's either the market believes there's going to be a period of extremely fast growth in the near future, or the company is overvalued. Your job is to determine which of the two it is. This is the qualitative part of it, financial analysis. Now, I've touched on these a little bit earlier, but when we get these numbers from a company, what are we comparing them to? How do we know whether they're good or bad numbers? Because there's so many different values that could be bad and so many different numbers that could be good. What we're going to want to compare them to is the historic values. We're going to want to compare them to close competitors, and we're going to want to compare them to the industry averages. Kind of how I did with that original 1.53% of Teva Pharmaceuticals, I'm going to want to compare that to Pfizer Industries and the entire pharmaceutical industries and the 2013 growth rate of Teva Pharmaceuticals. I want to compare them to everything I can possibly compare them to see whether they're doing better than themselves, better than competitors, and better than the industry. Those are my 3 sets of criteria I really want to see. Now, the cash flow analysis is our third measure of analysis. And what we're going to do with the cash flow analysis is see where the money's coming from. What we want to see is more money coming from operating activities and less money coming in from other types of activities. We want to see operating activities because we don't want a company whose job is selling hamburgers to be making all its money by acting as a bank and lending its employees money. We don't want to see Sharpie, the Sharpie corporate, we don't want to see someone trying to sell Sharpies making all its money from selling pads of paper. We want to see that its operating inflows are greater than all its other inflows. An operating inflow is going to result from the sale of goods and services. Operating outflow is going to result a short-term direct investment in the company's business. So this would be something like investing in inventories, buying new DVDs to put on store shelves, buying things you're going to sell. Investing inflows is going to be your sale of physical assets. So it's going to be like selling a tractor you had previously owned, or selling a factory, getting rid of an office building. Those type of things are going to what's called investing inflow. And now, if that's a positive number, that's kind of, it's going to be very, investing cash flow is a positive number. It's going to be kind of worrying to us. It's why are you liquidating assets? Why are you getting rid of the things that can make money in the long term? Now, moving over to the investing outflow, it represents a long-term investment in the company's business physical capital. So this would be like buying a tractor, buying a new factory, all those type of things. A financing inflow is initial cash or loan from other financing activity. And a financing outflow would be the payment of interest expense or other financial requirements. So the inflow would be like getting that initial $2 million from the bank when you take out a loan, and the outflow would be paying that money back over the course of the lifetime. So the only number we're going to look at from here is the quality of income ratio, is what percentage of my net income is coming from my operating numbers. This can be anywhere from 0 to 100 to infinity. The higher, the better. 100 is going to be our benchmark rate, though, because that's saying 100% of our net income is coming from cash from our operating activities, which is what we want the company to be. If it's very low, it's going to tell us that all the money they're making didn't come from their core business structure. So here are some cool charts to look at. It's kind of the cash flows in the firm's business cycle over the course of everything. When you introduce a business, let's look at this top graph here. When you introduce a business, your cash flows you're not going to be making that much money. Your revenue is going to grow during the growth stage. It's going to peak at the maturity stage right here, and it's going to decline through the end of the business. In net income, you're going to be losing money when you first start a business. You have to invest to buy that initial, let's say we're making a coffee shop. You're going to have to invest in that initial storefront, the initial capital, the initial capital, the initial ice cream, the ice cream scoops, the cash registers, the chairs, all those type of things. That's what's going to make your net income negative in the introduction stage. You're going to move to the growth stage. You're going to start making money. You're going to hit your peak at the maturity stage, and your decline, eventually going back negative in the decline stage. Now, looking more specifically at this bottom chart, you can see how the cash flows act. And what you can do is say, okay, let's look at financing. Why would financing be very high at the beginning? Well, you're taking out a loan. You get an initial $2 million out from your financing activities during your introduction, so those are going to be very high. Your operating revenues, though, you're going to be buying a lot of ice cream scoops, and all those cash registers. Those are all operating things that are going to produce money in the long run, but right now it's money out of your pocket, so they're going to be negative. Your investing activities, that storefront, that chair, those chairs, that furniture, freezer systems, all that type of thing, those are going to be negative to start off. As you can see, as you're going through the growth stage, your operating cash flows move positive. Your investing outflows move positive once you start to sell your assets, once you start to sell your storefronts. And your financing, as you pay off more and more of your debt, is going to go further and further negative. Now, what this tells me is if my financing number is very far negative, my operating number is decreasing, and my investing number is kind of positive too, this might tell me the company is in the end of its life cycle. If my financing number is very, very high and both my operating and investing cash flows are very far negative, that's going to tell me it's in the introductory phase. And you're going to be able to do this when you look at a cash flow. You're going to be able to say, okay, what position is the company in of its life cycle? Now, when we're looking at resources, we want to look at resources of where we can get this information. A lot of this information is going to be predetermined for you. CNBC, Google Finance, Morningstar Financial, they're going to have the price per earnings ratio, the PEG ratio, all that stuff we were talking about, the income statement, pretty early on. Not pretty early on, but pre-calculated for you, as well as a whole host of other analysis tools. Somewhere you're going to be able to get the financial statements yourself, so you're going to look at the cash flows and all those types of things. That's going to be the company's investor relations page. It's where I got Teva Pharmaceuticals information, and it's where it's a great, every publicly listed company worldwide is going to have an investor relations page. Now, on JHU's campus, we have 3 different locations where you can get on a Bloomberg terminal. Now, any student can get on a Bloomberg terminal. They're complicated to use, but once you get the hang of it, you can find the basic information. It's how Michael Bloomberg made all his money. It's an extremely invaluable resource to an investor. You can get pretty much every piece of information you could possibly know about any mutual fund, hedge fund, stock, ETF, market, anything your heart desires, you can find on the Bloomberg terminal. You can find 3 of them on MSC. You can find, I think, 2 of them in the econ department on like this 5th floor of Morgenthaler, and you can find 1 of them in the Career Centers department. So I really encourage you guys to go and check those out. But this concludes our presentation on the basics of fundamental analysis, our introduction to it. I hope you learned something, and I hope you learned something from the workshop that's going to follow. Thank you.